Our next guest thinks there is more pain to come in the tech trade. Let's bring in Dan Niles, founder of the tech-focused Centauri Fund. Dan, great to have you with us.
Great to be on, Melissa.
Are you worried about inflation, and is that influencing how you're running your portfolio right now?
Yeah, I mean, if you go to danniles.com, CNBC had me on December 29th, and I said my number one picks for this year were related to inflation, economy opening up, running hot, and that was, we had JP Morgan in there for rates going higher. We had the XLE in there, which is the energy ETF, and this is all on danniles.com, and that's how it's kind of playing out. So that was our number one theme we based the portfolio on, and that's why we've had the best start to any year, actually, in our 17 years of running the fund, is betting on that, and then betting on the fact that tech would have a tough time as rates would go up. So that's why we only have one tech name in that portfolio for this year in terms of our top 5 picks that we had.
Hey, Dan, danniles.com. It's Tim. Thanks for joining us. And I guess my question for you is the simple one as a portfolio manager and one that spends a lot of time looking at bottom up. What are you doing with a higher, a 160 10-year differently than you were doing at 60 basis points?
Not much, because I think it's going to get to 2% or higher before this is all said and done by late this year. The one thing we did today is, we had a lot of tech shorts on and high multiple, no profit software stocks that had, had ridiculous valuations. We actually covered about 70% of shorts across our portfolio. I think there's some good names getting thrown out with the bad ones. And so for us, we love days like this because it gives us a chance to, cover some things and then potentially look for names that we like on the other side of it. But I think, the reflation trade in terms of if you're looking at certain sectors like energy, like banks, they have a long way to run because you've had, rates going lower arguably for 40 years, but at least since the global financial crisis, you've had energy people cutting back on spending in that, or the mining sector or the agricultural sector, which is why we don't believe much the Fed saying, this is going to be a temporary increase in inflation. We don't believe that. We think it's going to actually be pretty persistent and increase from here as the global economies open up. So for us, when they start hitting some of these names, like in the mining space, et cetera, it makes us very interested in terms of adding to our exposure in sectors that have been given up for dead over the last several years.
Hey, Dan, it's dannathan.com here. Listen, I got to know you back in the late 90s when you covered semiconductors and obviously some hardware. These were hot sectors back then. They've been hot right now. Can you help us understand a little bit what's happened in semis just this week alone? I think that Micron is a great example of a company where people think that everything was going really well in the supply-demand dynamics, the pricing of DRAM, all that stuff was great. It's a cheap stock. There was more room to run. They pre-announce a great number, and the stock goes down 12% in a straight line over the last couple of days. How does that filter into a little bit of the psychology about tech right now in a space that should be doing very well given those dynamics?
Well, I think there's a couple of things to remember. Semiconductor companies are notorious for having no clue as to what's going on because they're at the back of the supply chain. So if you think about it, you've got Apple, AT&T arguably, Verizon at the front of the supply chain for smartphones, Apple supplying into them. Obviously, they sell a lot directly themselves. Then they have that manufactured at Han Hai. And then you get around to Micron shipping to Han Hai, which ships to Apple, which ships to AT&T and Verizon. If you look at inventory in the supply chain, including vendor trade receivables, for example, at Apple, inventory is up a ton. If you look at TSMC's balance sheet and you look at the inventory on their balance sheet, it is up a tremendous amount year over year as well. So you've got actually inventory in the smartphone supply chain for one, building up. Now, in other sectors like automotive, PC, it's not that bad, but that's one space where it's actually built up tremendously. And so I think, much like a few years ago when DRAM cycle was going to continue forever and, was permanently going to be at a new high, and then all of a sudden prices started to crash. I think you have some risk of that in certain sectors. I'm not sure it's in DRAM or NAND, but I do think in the wireless supply chain where they play, there is a little bit of that. And the stock's not cheap, by the way. I mean, it's trading at, I think, 1.5 times book, if I remember correctly. The stock's bottomed out in the past at 0.5. So, yes, if you put huge EPS numbers out in the future, it looks great, but that's not one of the, we have other names that we like a lot better in tech, like Google, like Facebook. If you want to be in stuff where you're getting growth at a great price that has a long runway ahead of it. And, fortunately today they actually hung in very well, which was interesting, I think. And, they'll benefit as ad rates pick up as we get really strong GDP growth. And so that's kind of where I'm looking. And today's a great acid test of where are people overly optimistic versus where are spaces that are priced, at a good price. And I think those are two names, for example, that I like much better than commodity semiconductors or semiconductors in general.
Dan, just quickly, was there anything that you bought in today's session, and more specifically within technology, since the NASDAQ is now down about 7% for the year?
I really thought about buying some more Google. I didn't end up doing it. But what we did was, as I said, a majority of our shorts are all sitting in technology. And we covered about 70% of our short book in the entire fund. And so software, high multiple software stocks with no earnings, that's where we went in and we covered a bunch because that was the sector we hated the most, because that's what's going to get hit hardest when rates go up. But, we're sitting on some cash right now in the fund. I have a feeling over the next day or two we'll start deploying it. I think you got 1.9 trillion in stimulus coming. I'm sure those people who get those checks, a lot of that will find its way into the market. And I think we maybe get one more surge higher, and then I think that's it. And we've got a lot of pain in front of us after that when rates continue to head to 2%.
Dan, thank you so much for your time. It's always great getting your perspective.
Thank you, Melissa.
Dan Niles. Okay, I think that was an interesting point at the end, too. Stimulus on the way. A lot of that stimulus, or a portion of that stimulus, could be deployed in the market, although it could be a little bit different this time in that it might be more targeted in terms of income. So, Tim, does that factor in at all to your more bullish view versus the other traders?
Well, it's certainly a backstop here, and thinking about what stimulus checks meant for actually direct flows into the market. But I think about it also as it relates to how that money was being spent in the economy and some of the consumer stocks. And, for example, we've talked about this, Walmart's pulled back as it's been a reopening. I thought this was, there was a COVID dynamic, but if anything, it's a reopening trade as well. I think there are the things that I would be looking to invest in around stimulus are those stories where I think the consumer, Best Buy, a place where I think those stimulus checks are going to go. Apple is where those stimulus checks are going to go. So, but overall for the market, yes, and cash levels in the market right now, are at reasonable levels to feel that there's a decent backstop here. Again, I don't think we're that far over our skis in terms of equity allocation. I think we've talked about companies, and Dan talked about the companies that he went short, that are companies that just don't make money in the multiples. And I think that's where the market's actually had a pretty rational thought process over the last month.
Karen, just quickly, did you cover any of your IGV, the software ETF shorts?
I did not, but I definitely looked at it. It was down. I mean, it's down a lot. It was down 3% today. At one point, it was down 4%. It's time to start covering.
All right.
I will probably do that tomorrow.
Shepard Smith here. Thanks for watching CNBC on YouTube.